inflación precisamente como uno de los principales problemas que tenemos sobre la mesa, o al menos una de las principales preocupaciones que tienen los inversores, el mercado. La inflación, subidas de tipos. De hecho, recordemos que ahora para marzo es cuando esperamos que la Fed tome cartas en el asunto, también muy pendientes de lo que pueda decir el Banco Central Europeo. Con todos estos frentes vamos a poner el foco del análisis y lo vamos a hacer con AllianceBernstein, en concreto con Nick Davidson, es Senior Portfolio Manager Equities de la gestora. Nick, thank you so much for having us a few minutes.
Good evening, it's my pleasure to be here.
Nicholas, inflation, rate hikes, and now geopolitical tensions between Russia and Ukraine. We have many open fronts, and from your point of view, what are right now the main challenges you see or you forecast for 2022 in equity markets?
Yes, you're right. There's clearly a lot to be concerned about today. And I think at the moment, what's going on in Ukraine is understandably the largest source of anxiety for investors. And clearly, if things escalate from this point, if, for example, we see reductions in the supply of gas to Europe that drives energy prices up, that could further slow growth in Europe and elsewhere, and that could be quite negative for equity markets. But if you look at what's typically happened historically, when we've had these kinds of geopolitical crises impacting markets, there can be quite a big initial effect, but typically markets recover, and that effect doesn't last too long. So I think as we move through the year, the greater concern will be what is always the greater concern for equity markets, and that is, can companies continue to grow their earnings? And what we've certainly seen in the most recent earnings season is that companies are continuing to grow earnings well. And if the global economy continues to grow at a good pace, as it has been doing, then I think we'll see earnings grow, markets doing well. What we've always seen in the past is if there's no recession, equity markets continue to produce good returns. And I don't think recession is anybody's base case at the moment.
And how are equity markets likely to cope with a period of high inflation?
Yes, if you look historically, what's been bad for equities is not inflation, but deflation. If prices are falling, if economies are shrinking, companies can't grow their earnings, and that's when equity markets really suffer. But equities are real assets. And again, if you look historically, when we have had periods of moderate or higher than usual inflation, equities have typically continued to do well. I think the real risk that investors have to watch out for is if inflation gets out of control. Central banks have to, as it were, slam on the brakes, really slow economies down to get inflation under control. And if that happens, that could be worse again. That could cause the recession under which equity investors typically do badly. But I don't think that's anybody's central case at the moment. It is a downside risk. And in the meantime, I think what equity investors need to do to protect their portfolios against those risks and against the risk of margin compression in particular is really emphasize investments in quality companies that have strong pricing power. And of course, they tend to be the sorts of companies that we are focusing on in AllianceBernstein's own portfolios.
Nick, you mentioned deflation. Is deflation still a worry between investors?
I think it isn't today, but historically been bad. It's not inflation, but deflation. Now, clearly there are one or two places in the world, notably Japan, where that risk has not gone away. But no, I don't think that's the key concern today.
And what about rising interest rates? Will they hurt equity returns? We expect the first of them from Fed in March.
So again, if you look historically, periods of rising interest rates have generally been good for equities because those periods of rising interest rates have usually been associated with periods of strong economic growth, which has been strong for company earnings and therefore strong for equity markets. Now, what we're seeing at the moment, I think, is a transition from a period of unusually, historically ultra-low interest rates to a period when central banks are trying to normalize policy, at least to some extent. And I think it's not surprising that that's caused some volatility and that some of the downward moves we've seen in equity markets this year probably reflect investors having to get to grips with that change in monetary policy, maybe happening a bit sooner and a bit more quickly than they were expecting. But I don't think in and of itself it's bad. And I think probably the rise in interest rates is going to be more a driver of a shift in leadership within equity markets than it is probably a driver for the direction of equity markets as a whole.
We always have this debate between value and growth. Will value continue to outperform growth?
So when I say interest rates are important for which style leads, what I really mean, I think, is that yes, if interest rates continue to rise, that's likely to be good for value and bad for growth. Now, the reason for that is if you think about what you're doing when you buy a company's equity, you're really buying a share of its future cash flows. And the value of those cash flows today reflects the interest rate at which you're discounting the cash flows to today. So all else equal, if interest rates rise, the discount rate goes up, the value of those cash flows today is a bit lower. Now, that impact is just much more severe for growth stocks than it is for value stocks, because with growth stocks, more of those cash flows are coming a long time in the future. A higher discount rate has a bigger impact on value today. And certainly, again, if you just look empirically at what's happened over the last 3 or 4 years, as we saw interest rates come right down, the valuations, the multiples investors are putting on the earnings of growth company shares shot up. And as interest rates have come back, have gone up again, those valuations from growth companies have started to come back down. Whereas you've seen very little impact on the valuations of value stocks. So I think that change in interest rates is likely to be good for value. Clearly, there's quite a bit happened already. We've had a violent style reversal already. But if you look at the gap in valuations, both between the cheapest stocks and the most expensive stocks in the market, or just at the way MSCI, the index provider, constructs its value and its growth indices, the gap in valuations between growth and value is still very close to historic highs, far higher than it's been for most of the last 10 years or so. And so I think, although we've seen some growth to value rotation already, I do think there's a long way for that rotation still to go.
On the other hand, every year we expect European equities to outperform US stocks. Could this finally be the year when Europe does better than the US?
Well, I think you're right about that. Clearly, lots of people have called for several years that this is going to be the year when European stocks finally outperform growth. But I do think that the probability of that at the moment is higher than it's been for a while. And certainly since late November, European stocks have outperformed US stocks. And I think there are a few reasons for that. Partly it is what I was just talking about, the rotation from growth to value. The European stock market just has more value stocks. The US has more growth stocks. The other aspect of it, I think, is the sectoral composition. Again, the European market is more exposed to cyclical sectors, like industrials, for example, or materials. The US market has less exposure to those more cyclical sectors. And so as we continue to see this process of the global economy emerging from the impacts of the COVID epidemic, with growth still high, earnings in those cyclical sectors are tending to do better. And that's, I think, benefiting Europe rather than the US. And then the final point is simply, again, if you look in the differences in valuation, and over the long run, starting valuation tends to be your best guide to long-term returns, European stocks just continue to be significantly more attractively valued than those in the US. And I think that also bodes well for strong performance.
Clearly, we will continue monitoring the European behavior. Thank you so much, Nick Davidson, Senior Portfolio Manager Equities in AllianceBernstein. It's been a pleasure.
Thank you very much. It was great to talk to you.
Y con todo este repaso de algunos de los principales frentes, insistimos, que tenemos sobre la mesa, la elevada inflación, esas tensiones geopolíticas entre Rusia y Ucrania, las posibles actuaciones de los bancos centrales, son los principales mensajes con los que nos quedamos de este análisis.